October 16, 1973. Riyadh, Saudi Arabia. King Faisal sits in his palace, his hand hovering over a decision that will reshape the global economy for the next 50 years. Outside, the Desert Kingdom pumps roughly 8 million barrels of oil per day, generating modest revenues that have kept the royal family comfortable, but not extraordinary. The king has just received word that American cargo planes are airlifting weapons to Israel during the Yom Kippur War. His advisors tell him the West believes Arab oil is powerless, that the industrialized world can simply take what it needs. They were catastrophically wrong. Within days, King Faisal orchestrated an oil embargo that would quadruple prices from $3 per barrel to nearly $12. By 1981, OPEC nations had accumulated a staggering $450 billion in current account surpluses, equivalent to $1.4 trillion in today's money. Saudi Arabia alone banked $160 billion between 1974 and 1982. The Arab world appeared to have won the ultimate lottery. Western economists predicted an era of Arab prosperity that would last generations. Newspaper headlines proclaimed the birth of petro-kingdoms that would rival European powers. But here's what those headlines didn't capture. Within 2 decades, many of these same oil-rich nations would find themselves drowning in unpayable debt. Iraq, flush with oil reserves, went from zero external debt in 1979 to $86 billion by 1989, a debt-to-GDP ratio of 278%. Venezuela, sitting atop the world's largest proven oil reserves, would eventually see its economy contract by 3/4 and accumulate over $150 billion in debt. Nigeria, Algeria, and others found their populations poorer, despite pumping billions of barrels. How does the greatest resource windfall in modern history transform into a poverty trap? The answer reveals an economic paradox so counterintuitive that most experts still struggle to explain it. The resource curse, or what economists initially called Dutch disease after the Netherlands' disastrous experience with natural gas in 1959, describes a phenomenon where natural resource wealth actively destroys an economy rather than building it. When a nation discovers oil, its currency strengthens, making all other exports uncompetitive. Manufacturing collapses, agriculture withers. The economy becomes a single-crop plantation, except the crop is buried underground and its price is determined by forces completely outside national control. The key players in this drama span 3 groups. First, the oil-producing Arab states, Saudi Arabia, Iraq, Kuwait, Libya, UAE, and others, suddenly holding leverage over the industrial world. Second, Western commercial banks like Citigroup, Barclays, and Credit Suisse, desperate to find borrowers for the tsunami of petrodollars flooding their vaults. Third, developing nations worldwide, facing oil import bills that had tripled overnight and desperately needing loans to avoid bankruptcy. At stake was nothing less than the architecture of the global economy. The 1973 oil shock revealed that economic power had shifted, but the infrastructure to handle that shift didn't exist yet. Previous commodity booms had been manageable. This was different. The volume of money, the speed of accumulation, and the fundamental dependence of industrial civilization on petroleum created conditions without historical precedent. To understand how the greatest wealth transfer in history became a debt trap that persists today, we must examine the economic forces that transformed black gold into fool's gold. The money arrived faster than anyone knew how to spend it. Between 1974 and 1982, Saudi Arabia's central bank, SAMA, found itself managing a $160 billion current account surplus, with 90% of OPEC's total windfall concentrated in Arab Gulf states and Libya. But these kingdoms faced an impossible problem. Their populations were small. Saudi Arabia had perhaps 7 million citizens, Kuwait barely 1 million. Their domestic economies couldn't absorb the capital. Building infrastructure, Schools and hospitals could consume perhaps 10% of the annual surplus. The rest needed somewhere to go. The solution seemed obvious: invest in the West. On June 8, 1974, Saudi Arabia signed a landmark agreement with the United States, establishing what became known as the petrodollar system. Saudi Arabia would price oil exclusively in U.S. dollars and invest surplus revenues in U.S. Treasury bonds. In exchange, America provided military protection and weapons systems that had previously been denied. Almost overnight, Saudi petrodollars began flowing into U.S. Treasury securities and the eurodollar market, dollar-denominated deposits in European banks. Western commercial banks suddenly found themselves with a spectacular dilemma. Arab depositors were parking billions in their vaults, earning modest interest. But banks make money by lending, not holding. They needed borrowers. As political journalist William Grider later observed, banks collected the deposits of revenue-rich OPEC governments and lent the money to developing countries so they could avoid bankruptcy. The match seemed perfect. Oil exporters needed safe returns, developing nations needed capital, and banks could profit from the spread. But there was a problem. The lending wasn't based on productivity or development potential. It was based on desperation and collusion. The 1973 oil price spike had created immediate crisis for oil-importing nations. Countries like Brazil, Mexico, Pakistan, Nigeria, Egypt, and the Philippines saw their import bills triple while export revenues stagnated. The IMF estimated that the foreign debts of 100 oil-importing developing countries increased by 150% between 1973 and 1977. Banks weren't making careful credit assessments. They were pushing loans onto anyone who would take them, because sitting on Arab deposits without lending them out meant losing money to inflation, the very inflation that the oil shock itself had triggered. The terms revealed the dysfunction. Loans carried floating interest rates tied to markets increasingly volatile due to oil-driven inflation. Repayment assumed oil prices would stay high, guaranteeing continued petrodollar recycling and ensuring borrowers could export enough to earn repayment dollars. The entire system was a circular Ponzi scheme. Oil exporters deposited dollars. Banks lent those dollars to oil importers so they could buy oil, which generated more petrodollars to deposit. By 1981, developing nations had borrowed so aggressively that their total debt exceeded what they could possibly repay from export earnings. Over 70% of this debt was concentrated in 9 countries: Brazil, Mexico, Egypt, Pakistan, Argentina, Peru, Democratic Republic of Congo, South Korea, and Nigeria. The crisis was building, but everyone involved had incentives to ignore it. But the oil-producing nations themselves were falling into their own trap. The pre-source curse, a term economists developed after watching pattern after pattern repeat, describes what happens not after oil production begins, but after oil discovery, when governments start spending based on anticipated future revenues rather than actual cash in hand. Ghana discovered offshore oil in 2007. President John Kufuor proclaimed, "Even without oil, we are doing well. With oil as a shot in the arm, we are going to fly." Instead of flying, Ghana borrowed $4.5 billion international markets against future oil revenues while only saving $484 million. By 2015, growth had crashed, and Ghana was in an IMF program. Mozambique discovered massive offshore gas deposits in 2009. Forecasts predicted sustained 7% growth. Instead, off-budget borrowing, debt hidden from public accounting, exploded, and growth collapsed to 3% by 2016. The Arab nations weren't exempt. Iraq provides the most spectacular example of oil wealth transforming into catastrophic debt. In 1979, Iraq had zero external debt and foreign exchange reserves equal to 65% of GDP. Saddam Hussein controlled one of the most oil-rich territories on Earth. Instead of cautious development, Hussein launched a war against Iran in 1980. The conflict would last 8 years. Gulf Arab states, Saudi Arabia, Kuwait, and UAE immediately began lending to Iraq. By 1981, Gulf loans totaled $16 billion. By war's end in 1988, Iraq owed the Gulf states $40 billion. Total Iraqi external debt reached $86 billion by 1989, from zero a decade earlier. The debt-to-GDP ratio hit 278%. Debt service payments consumed more than half of Iraqi oil revenues. Iraq had gone from net creditor to catastrophically indebted in less than 10 years. What they didn't realize was that oil wealth creates a specific kind of governmental pathology. When a government derives revenue from oil rather than taxation, it stops being accountable to citizens. There's no need to build a competent bureaucracy to collect taxes or provide services. The government becomes a distribution mechanism for oil rents to political clients. This breeds corruption on an almost unimaginable scale. Saudi Arabia spent over $100 billion in the decades following the oil boom spreading Wahhabism, its fundamentalist interpretation of Islam, often through charities that doubled as funding mechanisms for extremist groups like Al-Qaeda and the Taliban. Angola, blessed with offshore oil, saw revenues disappear into bloated white elephant projects and unmanageable national debt rather than poverty reduction. Libya under Gaddafi used oil revenues to fund authoritarian control. When Gaddafi proposed moving away from dollar-denominated oil sales, Western intervention in 2011 contributed to his overthrow, plunging Libya into civil war and economic ruin. The economic mechanism destroying these economies was becoming clear. Oil revenue strengthened national currencies, making non-oil exports uncompetitive. In Gabon, oil discovery literally wiped out agriculture, industry, and commerce. And when oil ran out, the country had nothing. The entire economy had hollowed out. Manufacturing couldn't compete with cheap imports purchased with strong oil-backed currency. Talented workers abandoned productive sectors for government jobs distributing oil money. By the mid-1980s, both oil exporters and oil importers were trapped. Exporters had borrowed against future oil revenues to fund wars, vanity projects, and corruption. Importers had borrowed to pay inflated oil bills. Both bets assumed oil prices would remain high. Growing tension built toward an inevitable reckoning. Venezuela exemplifies the trajectory. By 2014, oil prices exceeded $100 per barrel. Venezuela's government, dependent on oil for 2/3 of its budget, spent as if that price would last forever. When prices crashed to under $30 per barrel in early 2016, Venezuela entered freefall. Export revenues dropped from $74 billion in 2014 to $37 billion in 2015. GDP fell 3.9% in 2014, 5.7% in 2015, and a forecast 8% in 2016. And that's when everything changed. Venezuela's collapse revealed the final stage of the resource curse, total economic disintegration. Between 2014 and 2021, Venezuelan GDP shrank by roughly 75%. Oil production, starved of investment and maintenance, fell to its lowest level in decades, despite Venezuela possessing the world's largest proven reserves. Hyperinflation made the currency worthless. Food and medicine disappeared from shelves. An estimated debt burden exceeding $150 billion left the country internationally isolated. The pattern had repeated across the oil-producing world, but with crucial variations. Nigeria and Angola, despite massive oil revenues, remained mired in poverty, corruption, and poor governance, classic manifestations of the resource curse. Azerbaijan and Kazakhstan saw GDP drop 4.3% and 2.5% respectively when oil prices crashed, despite earlier periods of rapid growth. Iran, with natural resource rents comprising 23.24% of GDP, achieved a Human Development Index of only 0.779, while Angola, at 20.25% resource rent, scored just 0.594. But not every oil nation failed. The UAE, Qatar, Kuwait, and increasingly Saudi Arabia demonstrated that the resource curse was not preordained. The UAE discovered its first commercial oil field in 1960. Instead of immediate spending sprees, Abu Dhabi established sovereign wealth funds. By 2025, GCC sovereign wealth funds collectively managed approximately $5 trillion in assets, projected to reach $7 trillion. Abu Dhabi Investment Authority controls over $1 trillion. Saudi Arabia's Public Investment Fund exceeds $900 billion, and Qatar Investment Authority manages more than $450 billion. The difference lay in institutional quality and long-term planning. Richard Audie's analysis noted that the autocratic character of the Arabian Gulf regimes provided the long-term horizon and insulation of government elites from short-term political pressures which effective absorption required. Prudent economic management during oil booms focused on maintaining fiscal balance, restraining inflation, and sustaining currency convertibility. These nations invested oil revenues abroad rather than inflating domestic economies. They built genuine economic diversification. UAE and Qatar developed finance, tourism, and logistics sectors that now operate independently of oil prices. But the divergence created a two-tier system within the Arab world and beyond. Oil-producing nations with populations under 10 million, UAE, Qatar, Kuwait, could distribute wealth while building sovereign funds. Larger populations like Saudi Arabia, now over 35 million, faced more complex challenges requiring genuine economic transformation. Saudi Vision 2030, launched in 2016, represents Crown Prince Mohammed bin Salman's attempt to break oil dependence before it's too late. The 2020 oil price crash tested this diversification, revealing how difficult escaping oil dependence truly is when oil revenues account for 67.44% of government budgets and 78.62% of total exports. For nations that failed to diversify, the curse proved catastrophic. Venezuela's oil production, once capable of 3.5 million barrels per day, collapsed to barely 400,000 barrels daily by 2020. The government now exports only to pay debt service, with 58% of the budget still derived from oil in 2024, despite output at historic lows. The tragic irony was that resource abundance provided the capital needed to build alternative industries, but the political economy of oil rent made such diversification nearly impossible. The 1973 oil shock promised Arab nations unprecedented wealth and global influence. The petrodollar system established Saudi Arabia and its neighbors as financial powers. But for most resource-rich nations, oil became exactly what economists had warned, not a blessing, but a curse that distorted economies, corrupted governance, and created debt traps that persist generations after discovery. The immediate aftermath of the 1973-1981 oil boom revealed consequences that few anticipated. By 1982, the Latin American debt crisis exploded when Mexico announced it could no longer service its foreign debt. The 1980s became known as the lost decade for developing nations, with stagnating and declining living standards when adjusted for inflation. Countries like Morocco and Egypt required Paris Club debt restructuring, partial forgiveness combined with extended repayment terms and lower interest rates. The poorest nations qualified for total debt forgiveness through poverty initiatives, tacit admission that the debts had always been unpayable. Long-term consequences proved even more destructive. The political economy of oil rent created governmental structures fundamentally incompatible with democracy and development. When governments derive revenue from underground resources rather than citizen taxation, accountability vanishes. Venezuela, Nigeria, Angola, and others saw oil wealth concentrate in the hands of political elites while populations remained poor. Chad, despite oil reserves, exemplifies the resource curse perfectly. Landlocked, with 15.5 million people, it ranks among the world's poorest countries. The abundance of oil correlated with economic underperformance rather than prosperity. The modern world reflects these decisions in unexpected ways. On June 9, 2024, the 50-year petrodollar agreement between the United States and Saudi Arabia expired. Saudi Arabia no longer prices oil exclusively in dollars or automatically invests surpluses in U.S. Treasury bonds. This shift reflects broader recognition that oil dependence, for producers and consumers, creates systemic vulnerability. GCC nations now manage $5 trillion in sovereign wealth funds invested globally, attempting to build post-oil economies before the energy transition makes their primary resource obsolete. This teaches us that natural resource wealth, particularly oil, creates perverse incentives that actively undermine development. The resource curse operates through multiple mechanisms: currency appreciation destroying competitiveness, rent-seeking replacing productive economic activity, corruption flourishing without taxation-based accountability, and boom-bust cycles from volatile commodity prices. The pre-source curse demonstrates that merely discovering oil triggers borrowing binges against future revenues, creating debt before production even begins. Two modern parallels illustrate the pattern's persistence. Guyana, South America's current wealthiest country per capita, discovered massive offshore oil reserves recently. Heavy dependence on anticipated petroleum revenues, weak institutions, and geopolitical pressure from neighboring Venezuela raise serious risks of repeating the resource curse. Meanwhile, Saudi Arabia's struggle to diversify despite $900 billion in its public investment fund shows how oil dependence resists transformation even with enormous capital and political will. The 2020 oil price collapse forced Saudi Arabia to divert capital from diversification projects toward healthcare and military spending, revealing that oil dependence remains the default when prices crash. The greatest wealth transfer in modern history became a debt trap because the economic structure of oil rent corrupts the relationship between governments and citizens, destroys non-oil industries through currency effects, and creates boom-bust cycles that prevent long-term planning. Only nations with small populations, exceptional institutional quality, and sovereign wealth funds investing abroad have escaped. And even they remain vulnerable to the energy transition that may soon render their underground wealth worthless. The resource curse nobody explains persists because oil wealth provides the means to avoid building productive economies, making poverty amid plenty not a paradox, but an inevitability.